Hello and welcome to the week ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index. So I'm just going to take a moment and ask you to read through the risk warning. I'll put myself on mute whilst you do that. Okay, so let's crack on. So without further ado, quick recap of what happened last week or this week as we're on Friday. So just a recap of the week that we've been. Basically, US stocks climbed higher this week, grinding to fresh record highs. And that's despite the US government officially shutting down after the Democrats and the Republicans failed to agree a funding bill to keep financing federal government. Now, as a result, the focus was this week very much on ADP payrolls as the highlight of the economic calendar, given that the shutdown actually meant that US non-farm payrolls, which should be released today, will not be released. Interestingly, ADP payrolls came in significantly weaker than expected, defying expectations and actually by 50,000, which is what economists had expected. Now, this data really highlights this weakness that we've been seeing in the US labor market and really has cemented expectations that the Federal Reserve will be cutting interest rates by 25 basis points in the October meeting, despite the ongoing shutdown. Now, Fed rate cut expectations have really helped drive the US stocks to record highs. This is the S&P 500. As we can see, it reached a record high there of over 6,730. Still, I mean, very much trading within the rising channel. The RSI is overbought, but we're, pushing above, grinding higher, still forming a series of higher highs and higher lows. There are no concrete signals of a reversal of any stage. The only thing is to be watching out for is this overbought level. So, there could be some consolidation or a pullback, but any pullbacks are really being considered as opportunities to buy the dips right now, even though valuations do look a little bit stretched because of this overbought level. So as far as levels to be watching, immediately on the downside for the S&P 500 is the 6,700 level. That was a high that we saw back just at the end of September. And then below that, the next level to be watching out for would be this one here, which is the 6,560. That was the low last week in September. But, we're not really, this is a long uptrend that we're looking at. To negate that long uptrend, you'd even need to be looking down at levels of 6,360. These were the September lows, or potentially even lower than that at the 6,150 level, which was the level that we saw as the high back in February. So that's the S&P 500. Just going to have a quick look at the NASDAQ as well, what's been happening there. Again, very similar picture, very much trading within that upward rising channel, series of higher highs, higher lows, and above the moving averages. Only thing to be watching out here is a little bit overbought, so we could see a little bit of consolidation, a bit of a pullback. Levels to be watching there, 23,000. We're pushing on to hit 25,000 fresh all-time highs. Just below that now as we're doing this, but on the downside, watch out for 24,000. That was the high that we saw back in August. And then in order to form any form of lower low, we've got the 22,930. So still, quite a significant way from those levels. That's the tech stock, which again, we're also finding that, being supported by this M&A in the tech sector, as well as the AI narrative, which seems to be back on track as well. So just finishing off with last week, gold also gained 2.7% on expectations of the Federal Reserve cutting interest rates further. That takes record highs of 3,896, so just below 3,900. US dollar, that had a down day, or a down week, should I say. But still, I mean, you know, we're holding up from those 2025 lows. We are under pressure, even though the Fed's expected to be cutting interest rates on several occasions. We've got that US government shutdown going on. Just as far as talking a little bit about the shutdown, you know, obviously if that goes into next week, it does mean that we're going to be very light on data from the US next week. This is the economic calendar that I've just pulled up. As we can see, very light on US data. We've got the Fed minutes, potential and a speech by Federal Reserve Chair Jerome Powell, and Michigan sentiment, and that is it. So those important figures such as US inflation data won't be released, PPI, these are the figures that the market and the Fed will have wanted in order to be able to really take well-informed decisions about a potential rate cut later this month. But the Fed is in effect now flying blind without that data. Now, I think, you know, the market even so is pretty convinced that the Fed will cut rates anyway in the October meeting. I suppose the question is what happens in December if this continues, but you know, we're not expecting it to be such a prolonged shutdown. Potentially, if it does prove to be a prolonged shutdown, that could start hurting risk appetite, and that would then weigh on stocks. But we're just not seeing that at the moment. We're seeing the stocks move higher on those expectations that the Fed will be cutting interest rates. So that actually brings us, as I said, to the Fed minutes and the speech by Federal Reserve Chair Jerome Powell. They'll be watched really closely for clues over what the Fed will be doing. As far as the minutes are concerned, these are the minutes to the September meeting where the Fed actually resumed rate cuts for the first time this year, reducing rates by 25 basis points. Although there are some signs of divisions opening up within the board. So, for example, Stephen Mirren, Trump's new appointee, voted for a larger 50 basis point rate reduction. And interestingly, Waller and Bowman, who had dissented indeed in the previous meeting, so not the September one, the July one, voting for a rate cut when other policymakers all voted to leave rates unchanged. They did actually fall back in line in the September, voting in line with consensus. So I guess, you know, the market's going to be looking for more information here, more commentary. Recent commentary from Fed speakers suggests that not all are convinced over the, over inflation being tamed. Obviously, inflation is that bit higher. We're not going to get that updated reading on inflation this week, but what is clear is that the US labour market appears to be weakening. So the market's going to be watching those Fed minutes for any further clues really around discussions surrounding the timing of the next Fed rate cut. The market's currently pricing around 97% probability of 25 rate reduction in October and another 80% of one in December. So also Fed Chair Powell, any clues, any suggestions, that hints that he gives in his speech with regards to the outlook for rates. If we're standing, if Powell pretty much is as good as confirming that October rate cut, then that's going to support these moves higher that we've seen both in gold and in the US stock market. However, if he does show some caution about this ability to be able to fly blind and take decisions, raise questions over the rate cuts coming, then, or certainly around the timing of the rate cuts, then that could actually just weigh on stocks and gold. This is the gold chart we're watching at the moment. We can see, it broke out of range and had this huge drive higher, series of higher highs, higher lows, trading above the rising trend line. We are very overbought, and we can see, we see some higher wicks on those latest candles, suggesting that demand at those higher levels was weak. So yeah, just have a look actually at that candle there, shooting star candle. Maybe just be wary of this one here. Can you see just below where my cross is there? So yeah, just need to be watching what's going to happen there. As far as levels are concerned, we've got this one here, 3,800. On the downside, that's the round number. It's also and then below that, we'll be looking sort of around this level, 3,700. You know, the support levels here are very staggered. We could see a fall lower, given the extent of the rally that we have seen and the fact that it is so overstretched, or at least a consolidation around this period. So yeah, levels to be watching if you can for the upside, 4,000. And I think, you know, longer term, I do believe that the outlook for gold is still strong, in the sense if the Fed's going to be cutting rates, if there is the ongoing geopolitical uncertainty, central banks are still buying up gold, but at these levels there may be a period of consolidations, or at least a pullback. So let's just talk about what else we've got going on next week. A couple of things going on for the Eurozone. We've got retail sales. ECB President Christine Lagarde is also going to speak. Now, Eurozone retail sales actually slumped in the previous month. They dropped by 0.5% in July, raising some doubts over whether, you know, healthy domestic consumption will continue to offset the economic hits from US tariffs. Interestingly, recent economic sentiment data for the region shows that economic confidence is holding up, although we did see a slight tick higher in unemployment to 6.3%. Still, this remains around record lows. Recent PMI data has also been encouraging, so you know, suggesting that the Eurozone recovery may be on the right path, be it very slow. As far as what all this all means for economic policy, for ECB policy, and you know, we've heard ECB President Christine Lagarde speak recently. The ECB is comfortable with where their policy sits at the moment. Inflation is around the 2% level. Growth, as I said, I mean, it's pretty stagnant, but it appears to be holding above that zero line. And with this in mind, we're expecting, you know, the ECB to support more of the same, that they're in no rush to move on rates again. And this is the euro US dollar that we're looking at now. In fact, we're finding that it's just in this sort of slightly stalled pattern, holding above that sort of 117 level, but not really making it above the 117.50 level. So just caught in quite a tight range at the moment. I guess, you know, given the uncertainty a little bit surrounding the outlook for the US dollar, in the sense that we've seen that trading pretty flat as well. But if we do get encouraging data from Eurozone retail sales, that could give the euro a little bit of a boost, especially against the US dollar, which may continue to struggle in light of the shutdown and Fed rate cut expectations. Technically, we're still below this rising trend line here. We are above this falling trend line, caught in a little bit of a limited situation. So, I mean, buyers are going to really be looking for a rise over that 117.50, a close above that. And then 118, which is that rising trend line, could bring 118.30 into focus. Really, sellers are going to be looking for a close around below this level here, which is the 117 support zone. If we get a close below that and the 50 SMA, which is at the 1675, then we could actually see a deeper sell-off towards, let me just extend this level here, sorry, there's quite a lot going on in this chart, isn't there, towards this level here, and also the 115.80. that was the lows that we saw back at the end of August. Whilst we're talking about Europe, let's just have a look at what the DAX is doing. Almost at record highs. We've seen it break out. It's in this consolidation pattern for quite some time. Now it's broken back out. It's risen back above that rising trend line that's dating back to end of April. Looking back up towards record highs of here 24,650. That was back in July. So that's the level that buyers are going to be looking to get above. RSI supports more gains whilst it remains out of overbought territory. So, I mean, above that level, the next level is going to be on target 25,000. And just on the downside, levels to be watching here, I'd say 24,000. You've got the 50 SMA, you've also got the round number just before you head back towards that consolidation area level. So let's see what else. We've got Andrew Bailey is also speaking next week. So we've got central bank governors out in force. Pound is really struggling, actually. I think Andrew Bailey is going to be speaking on Monday, and his comments are going to be watched closely, given that UK PMI data today, which actually shows it was significantly weaker than expected. And it points to momentum and confidence in the UK economy fading as we head to the November budget, which is not until the end of November, so still quite some time to go. But you know, the data suggests that there are concerns. We've also seen recent industry data which is suggesting that hiring intentions are at the weakest levels since the pandemic. So basically the outlook is deteriorating. There are concerns over the Labour government's ability to get sort of, you know, the fiscal outlook under control. And we've seen that also being reflected in the UK gilt auctions, which have seen sort of have been relatively weak, suggesting that global investors have been shunning government borrowing. Buying up government gilts, which again is not necessarily an encouraging sign. So with all this in mind, we've also got to keep in mind though that inflation is sticky, and the Bank of England is not looking to move on rates. But even so, the pound isn't finding support from the Bank of England's more hawkish position because of those concerns over the fiscal outlook in the UK. And for that reason, we're seeing the pound really struggling just around that, above that 134.40 level. So this is the falling trend line dating back to the start of the year. It's also the, around the 50 SMA as well. So, you know, if we do get some concerns coming across from Bailey, then we're just gonna fall, we could find the pound actually fall below that level. Obviously a lot depends on what's going on with the dollar as well here, and whether the dollar continues to find a little bit of support despite the well, I suppose it has a pound support because it fell last week, but if we do see some weakness in the US dollar as well, that may keep sterling US dollar relatively stable over the coming week. But yeah, if we do get any dovish signs from Bailey amid concerns over the outlook, which could then actually work to bring down inflation, then that could see the pound fall further. Interestingly, whilst the pound is looking rather lackluster, sorry, we'll just go over some levels. Levels on the upside to watch, you want to be watching for a rise above 135. That's a level if we do get a more hawkish sounding Powell, and then 136 on the upside. 134.40, sorry, is that support that we're testing now. A break below that brings 133.60 into focus. Break below there really does start to see some lower lows forming, could see a decline towards that 131.50 level. Interestingly, the FTSE is in a much better place, actually trading at fresh record highs again, around the 9,000, just under 9,500. So again, you know, really solid chart here showing a series of higher highs and higher lows, supported by rising sentiment surrounding the US and rate cuts, and also as we see those cyclical stocks on the FTSE improving, the miners are also tracking metal prices slightly higher. So the chart here supports further upside whilst it remains out of overbought territory. We are looking a little bit like we might be just tipping into overbought territory there, so we could see some consolidation levels. But again, this is a dip buying situation. 9,350 level on the downside to be watching. And then below that, we've got the 9,200 level, which is also the 50 SMA there. So what else have we got? We're working through it. We've also got the OPEC meeting this weekend. So let's just pull up some oil charts. OPEC. Now there are quite a few rumors here that the OPEC will in fact be increasing production in November, so they could agree to up to 500,000 barrels per day increase. Now that's significantly above the 137,000 increase that we saw with regards to previous oil production outputs. So that's got the markets a little bit nervous. Also, inventory data this week from the US showed an increase in inventory, suggesting that demand is also a little bit on the softer side. So, but really that potential increase in supply has seen oil fall. I think it's around 6% so far this week. Now, just levels to be watching. I mean, we're just testing that 60. The 60 level as we speak. So I'm just going to pop that in there. So around the well, we can see it actually, it's there. Can you see the 60? So we're just sort of below that. Just bear with me. Just for ease of viewing. We're just above that 60 level. Okay, that's sort of the area that we're going to be watching out for. But this is looking bearish, you know, we've got a break below that falling trend line, below the 50, 100 and 200 SMA, RSI is below 50, concerns of increased supply, potential slowing in demand given the potential weakening in the US economy as the labour market sort of shows signs of weakness. So if we get a break below this level 60, that could potentially open the door to that 55, 50 level on the downside. If we get a less aggressive production increase, then actually that could offer some support to the oil price because of the market's pricing in this quite aggressive cut, so increase. Sorry, so 61.50 immediate level to be watching on the upside. And then above that, really looking towards the 65 level in order to be able to claim any sense that things are looking more encouraged. But if we get above that 61.50, it does feel that we're back into this holding pattern that we've been back in since mid-August. Okay, and we'll have a quick look at the USD JPY. OEDA is going to speak next week. This is quite an interesting chart. It's a little bit messy, but let's just try and unpack this. Sorry, that just moves that. So we've had with expectations that the Federal Reserve will be cutting interest rates. We've seen, and the safe haven flows for the Japanese yen really supported this pair lower. Testing, look, it arrived exactly where we said it was going to test onto that level there at the 146.50. Tested resist support, has gone up. Look at this chart here. This is this candle here. It's just testing the 100 SMA at 147.80. Long upper wick, suggesting that there was little demand at that higher level. So levels to be watching here. Ueda's going to be speaking. We did see in the last Bank of Japan, the summary of opinions, which was released this week, suggested that there was a growing division on the BOJ board, and it was shifting towards the slightly more hawkish stance. So we're expecting the BOJ to be hiking interest rates again at some point, but this shift that we've seen may mean that it comes a little bit sooner than perhaps the market was expecting, which again has supported the yen. Levels to be watching 146.50, that's also the 50 SMA, and if we get below there, and the 146.20, watch out for 145 on the downside. On the upside, need a rise above 100 SMA at 147.75 to test this level here, which is the one at 48.50, just above the 200 SMA, to then pull the 150 level into focus. And then just finally, there's also the RBNZ. rate decision. Where they're expected to cut interest rates by 25 basis points, also expected to cut rates by a further 25 basis points before the end of the year. This is the chart that we're looking at here. We've got the price has recovered. Basically, it's worth noting as well that the governor, Christian Hawkesby, reiterated the bank's projections in the previous meeting to a terminal rate of around 2.5% by the end of the year. So the central bank resumed rate cuts in August after pausing in July in order to support the stalling economy and to stimulate it as US tariffs and stagnant housing market hurt confidence. So we've seen a pickup from the low here. This again, I think, is pretty much on US dollar weakness rather than anything else. We've seen this is going to be a key level on the upside, the 58.45 level, that's a 200 SMA. It's also the low that we saw back in May. So if we can get a rise above that, then that's going to bring this level here into focus, the 0.5880, which is the fib retracement level for the low from 2025 to the 2025 high. So that's the levels we're watching, but this is looking a little bit bearish here. We need to get above those levels in order to negate the bearish outlook. On the downside, sellers would need to take out that level there in order to potentially see a significantly move lower. So that is everything as far as no, we do have Canada as well. Quick one on employment in Canada. That has been quite a bit weaker. So figures surrounding Canada jobs market, unemployment jumped 7.1% in August as the economy lost thousands of jobs on those tariff curbs and weaker business confidence. That's basically a 9-year high. So the market's going to be seeing whether that trend continues. I'm going to have to call it a day there. Thank you very much for your time, and I look forward to seeing you next week.